Hey, what's going on, guys? Ray Dalio is one of the most successful investors and the CEO of the biggest hedge fund, Bridgewater Associates. Recently, he was talking about the current state of our economy and comparing it to the late 1930s when stock market dropped more than 60%. In this video, we will take a closer look at the similarities between the current state of our economy and late 1930s economy. Also, Ray will explain how to prepare for the recession before it's too late.
On the other hand, it's very much like the 30s in that in 1929-32, like 2008, we had a debt crisis, took interest rates to zero both of those times. When interest rates hit zero, you don't have the same kind of monetary policy, so they print money, they buy financial assets. In both cases they did. That caused an economic rebound in both of those cases. And it caused the stock market to rise a lot in those particular cases. And at the same time, it did not resolve the wealth differences. So that today, the top 0.1% of the population has a net worth that is equal to the bottom 90% combined. Okay, the wealth gap is the largest wealth gap that there has been since the 1935 to 40 period. And so while we have good conditions here, for the bottom 60% of the population, we have bad conditions. So the averages don't convey what the picture is because of this disparity.
Great Depression at 1930s had some major similarities to the housing bubble and global financial crisis of 2008. Before 1930, stock market skyrocketed and went parabolic within a number of years. This is when interest rates were close to historical average of 5%. After that bubble burst, Fed cut interest rates almost to 0%. Just like in 2008, after housing bubble burst, Fed also cut interest rate from 5% to 0%. By cutting interest rates so low, it drastically reduces borrowing power, and therefore people can borrow money cheaply and build more businesses, consume more, and as of the result stimulates economic growth. In 1930s, when S&P 500 surged to $30 within few years, shortly it dropped heavily back to $5 within only 2 years. Stock market lost 85% of its value. People were depressed and devastated. Years later, stock market slightly recovered and rose to $18, and this was the peak of 1937. This is the point where Ray Dalio draws parallel to today's market conditions. Shortly, stock market dropped again to $8, lost more than 50% of its value. Interest rates dropped to 0%, and wealth inequality between 0.1% of the wealthy people in the United States and 90% of the ordinary people was at new all-time high. During that time, interest rates remained low for more than a decade. Just like at the current state of our economy, interest rates are suppressed for more than a decade. And just like in 1937, wealth inequality converged again. Right now, 0.1% of the richest people in the United States own as much asset as 90% owned by the lower and middle class of people. It took nearly 13 years to recover after the stock market dropped at 1937, and it also took 25 years to recover after the stock market dropped at 1930s. Other similarities, as Ray Dalio describes, that we are currently at the late stage of the long cycle, and we still have a very difficult position, which means that if economics turns down tomorrow, there is not much Fed can do to stimulate another economic growth. You may ask yourself why? Because interest rates right now are below 2%, and Fed continues to print money. We need to raise interest rates to at least 4 to 5% in order to have some economic stimulation when the economy goes south. And we currently don't have that. Another similarity is we currently have a rising power in the form of China, just like we had in the 1940s the rising power of the form of Italy, Japan, and Germany. Let's see what Ray Dalio has to say about this potential conflict.
The most recent period that's analogous of this is the late 1930s. Let's say if you take 1937. So why do I say that? I'd say we're well along in the business cycle, the short-term debt cycle. We're in the 7th or 8th inning of that. Central banks are tightening monetary policy. That's where we are in that cycle. Similar to then, when we have, because of the printing of money and because technologies and other reasons, we have a greater amount of polarity, political polarity. I think this is an important issue. And that political polarity causes populism around the world. In other words, a strong individual to come in, get control of that situation while they're having that type of polarity. So the word populism, for example, in developed countries was not widely used until, you go back to the 30s, until more recently. Now it's, of course, common. And so we're also late in the longer-term debt cycle, meaning if you were to turn down, if the economy was to turn down, the ability to deal with that with lowering interest rates is very limited. And the ability to deal with that with quantitative easing is very limited for a variety of reasons. So it's very much like the late 30s. Mm-hmm. You can't find a time in which both of those circumstances exist. Populism together with that differences, wealth gaps, and so on. And then also we have a situation which is quite similar, I think, in we have a rising power in the form of China.
Let's talk about that, because in the 30s you had Italy and Japan and Germany rising to challenge the existing powers. How parallel is a growing China today to that era?
If you study history, I've made a point now to study history over the last 500 years very, very carefully. What you see is that in the last 500 years, there have been 16 times where a power comes to challenge an existing power, a rising power. So like you say, in Germany, within Europe, or Japan within Asia, that was the nature of that beast. That means that there's certainly rivalry. So with a trade war, a comparable power creates an issue.
So 16 previous examples of a rising power.
12 of which led to actual shooting wars.
So we
I'm not saying we're going to get into a shooting war, but I am saying that the history has shown that when you have wars, after a war you have a dominant power and you have periods of peace because you have a dominant power. After World War II, the United States was powerful both economically and also it had a monopoly on nuclear power. And so as a result of that power, the United Nations is in New York, the World Bank and the IMF are in Washington, D.C., because it determined that. And in history, then when you have the rising power to challenge the existing power, you have elements of conflict. I'm saying, I don't want to overdo this, but I am saying that we are entering an era in which anybody who reads history and policymakers around the world and recognize this, that this issue with China rising means that there are naturally going to be conflicts. And how do you resolve conflicts in a world market? You don't go to a court system. There's not a rule of law in the world that becomes dominant. So there is more of a rule of power, and that's a dynamic. So all I'm saying is, if I was to pick, you asked me when is most analogous. And I would say that the 1930s, where you take that period, the late 1930s, is an analogous period if you were to say cause-effect relationships, because how much power do we have in terms of monetary policy? How much populism do we have? Analogous, these are important things. And then also, where are we in the economic cycle? How are asset prices priced? And so on. So it looks the most analogous period. You can go back to periods and other periods in history, and you can find also other analogous types of periods.
So what can we expect now? Are we going into recession? Fed dropped interest rate again to 1.8% and continues to print US dollar, even though Fed insists that is not QE, aka quantitative easing. They're just buying government bonds and injecting more currency into circulation. So how is that not QE? Europe is already possibly in a recession with negative interest rates. Let's see what is recession and negative interest rates mean.
So let's define a recession. The official designation of a recession comes from a place called the National Bureau of Economic Research. It defines a recession as the period between a peak and a trough of economic activity. The organization doesn't give a set definition of economic activity, but looks to indicators like domestic production, employment, and retail sales.
We do have business cycles. God hasn't conquered the business cycle. President Trump hasn't conquered the business cycle. And it's hard for the Fed to conquer a business cycle, but they can at least try to smooth it out as they go through time. There are some other things outside of the country that could come to infect us. I'm especially worried about Europe. I think the European Central Bank has conducted a policy that has hidden some really bad credits, not just in Italy, but elsewhere. If I come to you and say, I'm going to lend you money, and by the way, I'm going to pay you to take it, you're going to make mistakes. You're going to stretch out on your risk spectrum, and you're going to make some bad decisions. That's human nature. It's not quantifiable, it's just human nature.
It's a human nature to do stupid stuff when money is accessible cheaply and easily. Well, negative interest rates did not hit United States, at least not yet. And I really hope it won't happen. But let's see what Ray Dalio thinks what will happen when the next recession comes by. Now the question is how to position yourself if the recession hits, or how to even profit if recession won't come anytime soon. This is Ray Dalio's best asset class that can perform at any time. It performs especially very well when there is a blood on the street.
You recommend that most portfolios should contain some gold. Why?
Yeah, of course.
Why? A lot of people think it's not of course. In fact, it doesn't make sense.
Well, first of all, to structure a portfolio, the best way to structure a portfolio is to have the right kind of balance in your portfolio. So, and some amount of gold. Gold serves a purpose. It is, first of all, a diversifier against other assets. You know, we have this risk-on, risk-off thing. We also have a monetary system. The Bretton Woods monetary system began after World War II, and it had the dollar as the world's reserve currency. There's a risk there. There's a lot of dollar-denominated debt and so on. If somebody felt that they didn't want to hold that and so on, you could have exposures to that. So it's a diversifying asset that is sensible, and you know, that's the main reason to have gold in the portfolio, 5 to 10%.
I think gold is a great way to diversify your portfolio. I will not recommend silver that much, as silver has a poor track record in recessions. Unlike silver, gold performs very well when the economy goes south, and we can probably tell by this chart. Also, high-yield cash flow stocks and real estate can perform as well, as you will receive monthly dividends. Bitcoin can probably perform well as well, as it is a digital gold. Why Bitcoin? Because unlike gold, it's very liquid. People can quickly sell those bubbly tech stocks and convert dollars into Bitcoin. Buying physical gold isn't that easy. Let me know what you guys think about Ray Dalio and his comparison. Leave your thoughts in the comment section below, hit that like button and subscribe.